Dearly beloved, welcome to episode 23 of the Confessions podcast with me, Chris Sweeney, and Mr. Hugh Hendry. How are you?
I'd like to share everyone with it's not a chocolate bar. It's another in a long list of microphones for those of you who like to comment. I don't know why I'm listening. You're just comparing me to Joe Rogan, who's got a budget of $100,000. So hello. We shall see. And yes, I get you. I need an arm, not my arm, but I need a mechanical arm to move with me. I'm on it. I've ordered it from Amazon. It is being dispatched to Florida, and then it's going on a slow boat to a small island in the French Caribbean.
Well, wasn't Jeff Bezos on St Barts? Jeff could have brought it over himself. Was he not in your neck of the woods pretty recently? Is he gone, or is he still there?
I believe he's gone. I have to say, I like the Bezos. I like him. It's just like a big plonker, a big idiot with the new girlfriend, and he's like, "Oh, I'm the richest guy in the world." But yeah, Jeff, all that money, and definitely some. What can I say? So another thing I like about Jeff, and another thing which is actually topical, is that he is funding cutting edge research into longevity of life. And again, when you're that rich, life is so damn good. You're like, I don't want it to stop. But that's kind of my thing as well. I'm fascinated, and at some point, maybe today, I'm going to discuss it because I'm actually trying to get into a situation to train my body, kind of not to eat for the majority of the day, to do the 20 hours fasting, 4 hours eat regime. And the hardest thing is you do periodically get overwhelmed with a bit of hunger. But as the body, maybe I'm hoping 3-4 weeks, what happens is the liver starts to produce it produces glucose rather than the introduction of glucose through sugary products, which then create these highs and lows and crashes, and it causes the pancreas to release insulin, and then lots of kind of bad things happen, diabetes and stuff. And I'm getting closer. Today I did a 5K run barefoot on the beach, not bragging. Actually, Chris, because you're a runner, we share that passion. That's correct.
Yeah. I run. I run most days. I run most days. Yeah, well, I do 5-10K depending on how much time I've got and that kind of stuff. Yep, I run most days
5-10K. And what is your 1K? Kind of what's your pace?
It depends. If I'm wanting to push it, I can get it under 4 minutes.
But steady state, kind of like
steady state. If I'm maybe doing a 10K and I'm just wanting to kind of put a podcast on and zone out, probably I'm looking at about maybe 4.5 minutes, something like that. 4.5 minutes. So what's that? That'll get me done about 42, 43 minutes, 44 minutes, something around that point. Mm-hmm. Yeah, I can do that, But I mean, sometimes I'm maybe 47 minutes. I'm not always. Depends, Depends. Sometimes. I don't run barefoot, so I'm out in the ice and the rain. So sometimes you've got to kind of slow down for that. But yeah, something about that. But not always, depends. Yeah.
Well, I'm barefoot and I'm on the sand and in and out of the water, but I'm slow. I am 6-7 minutes. They've been advising me that just to keep yourself going, you take a little cup of Brazil nuts and a coffee and wait 20 minutes and the hunger dissipates. And so I've been doing that this week, and then that gets me to 7 in the evening when it's dark, and I take an avocado and I'm stuffed. So I may be disappearing. I may.
Bloody hell! This sounds like if I'm going to find you dead one day, lying on the floor there. You know what I mean? In St Barts,
I know, and why do that? I find a great connection with that mindset and the mindset that I had as an investor. I think, did we discuss last week what is a contrarian? I always said look, I look like a moron, but in actual fact, I'm an oxymoron in that I'm a trend following contrarian. And what I was meaning by that, fun upon that. And that was very much a function of, we were introducing, and indeed we titled last week as paradoxical investing. It was a hedge fund masterclass, and it was the embrace paradox. And this takes you again back into this, what is my form of being a contrarian? And that is that, last week again, we did a screenshot and we showed the very long-term chart of the US government 10-year bond yield, and the lower the price of that asset goes higher. And that trend, that 40-year trend, is very much intact. So the sin of contrarianism is imposing prematurely your intellectual thought process. Like, it's fine to create conjecture and narrative, but until such point as it's aligned with the trend, is dangerous. I would say it's irrelevant. I would say that the hallmark of great investors is that they have the discipline to keep a very well-stocked fridge or an inventory of ideas, and that they're glorified night watchmen or janitors, and they know where everything is kept in the fridge, and they know, we need ice cream, it's the end of the meal. And so I think it's legitimate to have the idea about how inflation actually could become an item, an enduring item, and therefore it could destroy where the bond market is. But until such time as that bond trend reflects it, and believe me, if it does change, it'll change the course of its direction over the next 40 years. This is like an oil tanker. So it's not a speedboat. Wait until the 10-year bond yield goes above 2%. Now, I think I've been saying that for the best part of a month, but I really meant that for the last year. But we are getting closer to that 2%.
But I would say, no wonder we didn't get any ice cream chat, because the man who was editing it is living on a cup of Brazil nuts and an avocado. No wonder he removed all the ice cream chat last week. But I did appreciate it. There was a few suggestions. Somebody came up with Mackey's, which is a good Scottish brand. I don't know if that's why they were throwing it in our direction, but that is a quality ice cream. I do like a wee bit of Mackey's. So yeah. But anyway, c'est la vie.
Anyway, so contrarian, have ideas by all means. Be ruthless in managing the inventory of your ideas, and try and match the trend with your ideas to keep yourself out of trouble. And therefore, the parallel that I saw in all of that is the submission that everyone just accepts we're going to die, that we are royally FUCKED, and there's nothing we can do. And the more I look at it, again, it's like stock research or macro research. The more I look at independent scientific reports, it seems that you have a sphere of influence over the rest of your life, which is as great as 80%. The other 20 is kind of what you inherited from your existing genes, but there's 80% which you can change with regard to the threes of exercise, what you eat, when you eat, I guess, and then stress. Now, the last thing, I am a bit buggered. I mean, I wear a watch. What is it saying now? It's saying that it gives me a stress report. It's measuring as we speak. I'll come back to it. I've got to keep still. Normally it says, you're just insanely stressed, calm down. Anyway, Chris,
did you wear that when you were an active hedge fund manager? Did you have that on? Could you measure your stress when things went right and wrong with your fund?
I think my staff, I think, could measure my level of stress.
See, We won't mention the B words.
Medium stress.
Medium stress. I won't mention the B words.
Chris, you make me relax. You're relaxing.
Exactly. I'm like a soothing. I'm like chamomile oil.
A soothing balm. Yeah.
Anyway, on to the news as we do. 19th annual Hedge Fund Industry Awards happening coming up in Mandarin Oriental, New York City. Deadline for submissions Tuesday to February the 15th. You can go online and basically, public plan of the year, insurance plan of the year, endowment of the year, healthcare system of the year, family office of the year, sovereign wealth fund of the year, blah, 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 blah. Hugh, have you ever been to the Hedge Fund Industry Awards, the Oscars for hedge fund managers? And if so, what's it like?
Again, short answer, no.
All right, okay.
I was, would you believe, the recipient of fund prizes. But it's a big con. Most of them, 9 out of 10 of them, are a big con. You buy the prize. It's a function of money. 9 times out of the 10. I never bought.
Did you? So were you sitting there in the audience about the Oscars and the camera was panning from you and I don't know, Chris Hohen and Chase Coleman the third and Rockos, who's gonna receive it, and then it's Hugh Hendry and you stand up. Did you know you were getting it, or were you there on the element of surprise on the night?
Well, there was an element of surprise because I hadn't paid for anything, and when you don't pay, for sure you don't win. And so the guy who does win it is faking the, well, me? Really? I am not worthy. I am humble. I am humbled by this generous check that I made 17 days ago to the host of the I didn't attend these things. I'm very much Woody Allen. Like I would sit at home.
Did someone collect on your behalf? Did you send up an underling, or is it? Yeah. And again,
it is money. So you would be asked that you would be nominated, and you would be asked to host a table, right? And it's ching, ching, ching. It's like having a table with Nikki Beach in St Barts on New Year's Eve. I mean, it's outrageous.
And do you get to invite people, or do they tell you?
You invite? No, well, so you send your marketing team, and then you invite favored clients, and
right, okay.
And so we did that, but they knew better to say, "Hey, are you coming, boss?" Like,
What were you doing? You were at home in Notting Hill, just listening to Pink Floyd, or
watching the US close at 9 o'clock in the UK, and I'm thinking they're all scumbags. So,
fair enough. Another news point I wanted to mention was hedge fund manager, well known, David Neuhauser. You're familiar with him, Hugh? I guess he's a bit of a legend.
Never heard of him.
Never heard of him. I thought
a legend.
I thought he was a legend. And the way he's been reported in the media, I thought he was a big deal. No, he's a nobody. Okay, well, stay away. We'll discuss his comments anyway. He was talking about ARK, EFTs. Am I using the right lingo here, Hugh? ARK.
Well, ARK.
Okay, ARK.
And ARK. Do you know? So ARK is just a long only fund. It's not a hedge fund. There's nothing kind of wazzy-do. And it's run by a lady, a woman, Kathy Wood. And, diligent, whatever, had never really set the heather on fire. But she launched this ARK fund, and it was kind of early stage and kind of aggressive investor in cutting edge technology companies.
Now, it seems to have went through a bit of a bad period because from what I'm reading online, it's down 51% from its peak in February. But the reason why we're bringing it up is because this manager has said that it is a poster boy for all the things in the current cycle that you should not have been investing in. He calls it a ticking time bomb. So do you agree? Is there any lessons to be learned, or is that all just noise?
I don't know about the ticking time bomb. I think there's merit in what he's saying. And so I've lived long enough to have seen many cycles. And it's remarkable how the many, and of course the many, people who are investing, we call it retail, which is to say people where it's not their principal activity.
Jokers. Jokers, basically. Jokers. Plebs. No?
I'm saying there's a naivete.
Yeah, not professionals. Not professionals.
Yeah.
Yes.
And heavens, I still would walk back when I see the behavior of the professionals. It makes me wonder. But it's not... markets create mysticism. And there's nothing like a bull market to create legend, to create fantasy. And I've seen many bull markets. I've seen bull markets in East Asian economies and stock markets in the early 1990s. I've seen the same in technology stocks leading up to NASDAQ. Prior to that, actually, I lived long enough to see it in the Japanese stock market in the profound bull market of the 1980s. Use that metric of 9.9 times out of 10. They get celebrated as geniuses, and all they're doing is aggressively running a trend. And when it turns, they are exposed as not having a skill set to deal with the turning point. And that's the fear with Cathie Wood's, that her fund, the construction of it is leveraged, which is to say that whatever the NASDAQ does, it will match and exceed by a factor of 1.5 to 2.5 times. So it's a leveraged NASDAQ vehicle, and it creates that leverage through its stock selection in the, if you will, the immaturity of the businesses, that it then takes an enormous position. I reserved the right to change my mind. My superpower was I could reject everything that I had so vehemently argued for the day before. I could turn on a dime and sell it all or buy it. I had that mental...
You could amputate a limb if you needed to, essentially. You weren't going to let the infection take over the whole body.
And the centipede was, to that infection parable, I had 99 other legs. If I only had 2 legs, I might spend a longer period of time procrastinating left or right, like, can I lose the 100th leg? Yeah, gone. And Cathie's in a situation where her fund is traded daily, traded like a stock. So orders are coming in all the time. And so she's got money coming in or she's got money coming out. You can imagine with the recent performance, the money's coming out. And so the danger is, can she direct that flow and actually reduce her risk across the portfolio? Or is she being forced? Actually, what tends to happen is you're compromised and you end up selling what you can, which is the more liquid, bigger stocks. She would own Tesla and the like. You can trade them. And that makes the situation worse because the fund becomes more and more concentrated in the things that you can't trade. Yeah. And if the selling continues, that's your ticking bomb. It just goes. We saw that in the UK with the controversy surrounding a famous British manager, Neil Woodford, formerly of Invesco, and who chalked up an amazing record as an investor in large liquid companies, and then kind of got infected a little bit by a little bit of too much bullishness, if you will, for the new thing, and possibly the organization of his fund. I think he possibly regrets.
And also a cracking headline from the Times, which I'm seeing here, is Invesco in the doghouse again, along with 9 billion of your money. It's quite a nice wee headline, that. Anyway, Neil, all the best in your future endeavours.
There was, and it's funny again how these things just repeat. There was a controversy which kicked off 20 years ago in the UK, and another of these London firms, and they did the same thing. They ended up having an allocation in private equity, which is to say things you just can't sell, and they're in a daily traded fund. And so that's dangerous. And the regulator says, well, okay, you can have 10%, but no more, because you really will be taking on a risk. And they break the rule surreptitiously until it's revealed. And Peter Young, there was a manager, Peter Young, and he got caught, and the fund had been huge, and then the fund shrunken. And I secretly love Peter Young because he defended himself, and he came to court and he was dressed as a woman. He was like, Your Honor, what can I say? I'm a lady. I'm a foolish lady. I'd have given him a second chance.
But talking about Cathie Wood's troubles now, does that link to, because the NASDAQ this week has had a correction territory, which something to do with technology. Now, I've read a bit about it, but I'm not obviously as skilled or as experienced or as talented as you. So is that related? And what does that mean when it's entered correction territory?
Well, the media have these rudimentary, they cut corners. They have this rudimentary law, which is a bear market begins. And again, let me wind back, because I was saying that trend is important, and so gauging trend is important, and trying to not impose your narrative, but have the discipline to wait for changes in the trend. And so that dialogue is the media trying to hint at potential trend changes. One of the go-to points is when a stock or a market has lost 20% from the high to the prevailing present. They say it has entered bear market territory. Why? Why not? I guess in the context of the largest stock indices, it's rare, thankfully, that they have 20% corrections. So why not? Yeah, that's a major correction. And again, remember, and as we've seen, we were discussing, what's he called, Rando or Chase Manhattan the third.
Chase Coleman the third. Chase Coleman the third.
Coleman. And of course, I keep going back to my man crush on Chris Rockos. And they are purveyors. They are best of breed in managing leverage. And a lot of the backstory with my monthlies and my investment performance is me dealing with leverage. Chris Benodi had said to me at the beginning, a hedge fund is like getting the keys to a sports car, like a red Ferrari. And you got to take it around the block. You got to put your foot to the metal. Just don't kill yourself and bring that. It's like your father. Bring it back without any scratch. We chef. So, and a lot of the journey that we try and portray in these sessions is me going, I'm driving too far. And I think we're still, nominally stuck towards the end of 2005. And I've had a big correction. I think I dropped 7 in October and 5 in November. We'll go on and we'll look at that. But I've been 4 times leveraged. And I've got to reduce my speed. I've got to cut my leverage. Yeah, so it's the metaphor. I always think of it as being like a Formula One driver, which is to say, a stock market dropping 20% is a big deal, because there's a lot of people who are actively, like I was, and how those greats are engaged with leverage bets. So 20% can actually suddenly become 40 or 50, either way. So that's why it's important. Now, the NASDAQ, let me look at my screen, is not in bear market territory, but probably is approaching 10% correction. So, and so correction territory, they always start bringing the correction thing out around about 10%, 9 going on 10. Hey, we're in correction. And so correction it's the flirtation. Are we going to flirt? Is it going to flip? And then go to 20, because they love that. When it hits 20, they go, it's a bear market. Ooh. Whatever. Now, it has long been my view that NASDAQ and the Teslas and whatever, this one, Actually, I prefer to say the apples of this world, because I think 3 weeks ago, Apple hit the rarefied community of being $3 trillion worth of market capitalization, which is bigger in many, many, many countries. And so there's this rush to describe that as a bubble and as irrational. And I've been trying to say that as long as the 10-year Treasury bond yield is very low, and in March of 2020, it reached 40 basis points. At that level, when you come across riskless securities and not mature, but big capitalized technology companies have that feeling of being riskless, in the sense that with Apple, with its hundreds of millions of subscribers who are buying apps, there's not a day goes by I don't get an email from the Apple store saying, "Yep, we just charged $10 to your account." It's repeat, and that's going to continue as long as I'm on this planet, and that's what makes it riskless. And when the government bond yield goes to levels approaching zero, you can actually say that there is no upper limit to where those stocks can trade. The price can go to infinity, and that is not a bubble. It's not stupid. It's actually rational. And of course, the flip side applies equally. If the bond market is going to have a correction, and it is having a correction, last week we discussed that the first week of this year had been the worst performing week for the 30-year maturity in 49 years. And so it's doing things which the computer models which go back and they analyze it and they go, we're watching you, and we can define normal behavior. And as soon as something jumps from being normal behavior to being erratic, to being roguish, then we have this whole risk system that comes in. You get tapped on your shoulder. It's like, you're driving too fast, take your position down, which is to say people come in and they sell, and then these corrections can become bear markets. Anyway, so if the 10-year, and the speculation is we're very soon to see the 10-year cross above 2%, that has huge ramifications for the valuation of NASDAQ stocks. So NASDAQ, with its 9.4% peak to trough decline so far, is, I would say, simply reflecting or reacting to the backup in 10-year yields. In the last year, 10-year, since from the low 10-year yields have gone from 46 basis points to, I want to say, about 182, 1.82. I'm going to look and see what it is trading today. So that's why there's a correction in NASDAQ. Have I answered your question, Chris?
You have. But the one thing I wanted to also mention was that we talked about retail investors. Remember last year's GameStop, AMC, long and short of it is a lot of hedge funds had short positions. These people put stuff out on Reddit, social media, told people to buy it. And obviously then they squeezed out the hedge funds. A few hedge funds lost a lot of money. Now, JP Morgan have got a thing called the Through the Retail Lens, which is a tool that basically follows Twitter and Reddit to identify these things so funds can have sort of warning of these things. Would that be something, if you still had your hedge fund, would you be watching that? Or are these short squeezes kind of small potatoes, and a lot was made out of one example, being GameStop, which has become a sort of a well-known, it's almost a sort of dictionary term for something, but is it really that big a deal? Because I don't think many people can think of any others apart from GameStop and the AMC occasion when it actually had any real impact.
Oh, I mean, there's a far greater example, in terms of the economic importance, it was insane. When did it happen? 2008, or was it closer? But there was a point, so that Volkswagen, there was a point when, so the largest cap stock today in the world is Apple. Well, it kind of makes sense. It's a great company. Everyone gets it.
Yeah.
And again, where bond yields trade, we can make an argument for trading in. But about 15 years ago, the largest company in the world was Volkswagen. They make good cars.
Yeah.
But really the most valuable company in the world. And what was happening is that in Europe and occasionally in the US, but there are different voting shares and different liquidity, all ultimately owning the company, but different means of ownership. And given they have ultimate ownership of a business that has cash flow and which is subject to risk and is subject to the parameters of where bonds trade and price earnings ratios for stocks, we know what the price should be. And so we look at the most liquid stock line, the one that trades most commonly, to reveal the prevailing valuation. And then owing to the illiquidity, which again, I like because it's linked to the risks which are found in the ARK fund, the potential for the illiquidity to blow up the performance, to destroy the performance. Anyway, there are teams of arbitragers employed by hedge fund managers, and they look for, what you want to do is you want to buy two identical things trading at disparity. And so they look for times when, for eclectic, eccentric reasons or whatever, the illiquid line is trading at a disconnect with the liquid line, and you take the opposite position. And I think there was a takeover, there was corporate activity. It's very incestuous, the German car industry. I'm just retrieving this from my brain vault.
Spitballing, they call it in America, no? Is that spitballing? No?
Spitballing. Could be. I like that. I'm definitely spitballing.
Yeah, I think that's
there was something with Porsche and Volkswagen, and maybe Volkswagen was taking a move. Anyway, some of the characters in the German corporate world took it upon themselves to do a short squeeze on Volkswagen. And that is why Volkswagen became the largest company in the world. It was just, so we read it, and the team of small investors get this like bad rap. Well, it happens with the most knighted, the most celebrated of business insiders using it. And the commonality, and I mean, it really, like you say, AMC and GameStop, it was brutal. The price went from less than 4 to 440, which just shows you how tough people, the general public are scared of hedge funds and short selling. They think it's like, it shakes their moral compass. But who would short? Shorting, you've got an outside chance of making 100%. Why do I say outside? So not only does the business have to go bankrupt, but in a bankruptcy, there's always something left over. Well, always, but pretty much always. There's assets you sell, and so there's an administrator who sells the business off, and therefore is the receipts are. Typically recoveries run between 20 and 40%. So actually, the maximum you can get is what did I say? It's like between 60 and 80% is what you can make, but you can actually lose 1,000, 2,000, 3,000, 4,000, 10,000, 20,000% of your money. Who would do that? Which actually gives us a link, Chris. I can see a link.
Seamless link. A segue. Is that a segue?
Is I don't even know if it. Maybe it's a segue. You're the man of words.
Is that the thing you ride? Is that thing? Is that weird sort of thing you sit on? What's that?
That is a segue as well. That's why I'm hesitating.
Well, we're in November 2005, aren't we? November 2005.
We are, and I have this line. John Armitage
is a genius.
Is a genius. Who is John Armitage? John Armitage is a kind of peer of Crispin Odey. John Armitage, regardless of the reference to Crispin Odey, first and foremost, he's a damn good investor.
Hedge fund legend. Hedge fund legend. Would we go that far?
legend.
Yeah.
I have to say legend because of what I'm going to say, because this monthly, it was very autobiographical. It was like what was happening in my life would end up, when my son was learning to speak, and he had a fascination for trucks, but every time he saw a truck, he called it something beginning with F. And that could be embarrassing. Oh, in the street. And that would have been that. I'm sure that's in one of my months. It's probably in the damn book. And so here I had lunch in New York, and back in the day. So let me just stop sharing for a second. When I was working in Edinburgh, and I was watching Friends. My kids watch Friends now, but I'm watching the original.
Who was your favourite member of Friends? Who did you gravitate towards? Who did you like?
Oh, Chandler.
Chandler Bing.
He had the best lines. I thought he had the best lines. And you?
Probably Chandler Bing. Yeah, I like Chandler Bing. Yeah.
Not aging well, very kind of jolly when you see.
No. I think his personal life. I think he's had a bit of substance problems down. Poor guy. I think that's taken its toll on him.
So, and I loved especially if you live in Edinburgh. And there was an amazingly good investment portfolio management franchise, Lazard Frères. It was and it had that French, European, and it was in New York, and they were uber good. And they had a vacancy. Did I?
You were headhunted, Hugh. Were you headhunted? Is that what you're trying to say?
I was never headhunted. Never.
You were kidnapped in the streets of Edinburgh, flown off to New York, and said, "We need you. Work at this desk."
I had people who wanted my head on a pike, but I don't think I was headhunted. But for some reason, I found myself interviewing for the legendary Lazard Frères, and the idea was to work with another legend, William Vaughan Muffling the 23rd, 22nd, or whatever. All these silly names. Vaughan, Hugh. I'm going to change my name. Actually, I have changed my name. My name is Jean-Hugues Hendricks, but really it should be Jean-Hugues Von Hendricks. Maybe I've got to choose the Von. Maybe on a comeback, I'll be Von Hendry. And I found myself, it was Easter, and I found myself flying over to New York, having an interview in this, like one of those skyscrapers, seeing the view of Central Park, and everyone was razor sharp. I went back to Edinburgh going, am I going to work at Lazard, And evidently that didn't come to pass. And I tripped, my interest in Friends trailed off. I just couldn't bear to think of the life that I nearly achieved. And funnily enough, I was in Bagatelle, the kind of fun cabaret type bar restaurant, and they have an outpost, a legendary outpost in St Barts. And who's there is William Vaughan Muffling, and William has a place here. Sure, the last thing he wants is anyone talking about it. And I understand he is an avid collector buyer of the green zone. You were delivering sermons last week about how we have to be a bit more conscientious about our footprint on the planet. And I'm like, yeah, whatever. I'm here to make money. William is, to his great credit, is snapping up green zones where you're not permitted to build. And he's taking them off the market in perpetuity to kind of preserve. The great danger for this tiny precious island is one of too much building, or too much of anything is bad. And so William very much is in the vanguard of trying to stop that from happening. So that's anyway. So then we can come back and I can start shading again.
But did you go up to him and say, "Remember this face, pal? This is what you could have had. This is what you could have had. We could have been McCartney and Lennon."
Some people, he is taciturn, which is to say he doesn't say much. And we certainly had the briefest of conversations where I'm pretty much sure that I was channeling the internal dialogue in his head, and he was going, really? Did I come so close to working with this Muppet? Who knows?
We've also you got to give, if anyone's not seen it, you got to Google Hugh Hendry on BBC Newsnight. Was it when you give Joseph Stiglitz, who's a Nobel Prize winner in economics, very highly academic, and Hugh gives him a bit of a, shall we say, a roasting live on TV. Did you give that to William von Muffling? Did you give him a bit of a roasting? Oh no, it wasn't that. Okay.
No. I've got great respect for him.
Okay, fair play.
But it's actually, this is just all nonsense. Actually, I'm still stringing it together, Chris. Let me share again, because where have we been? We have discussed at lunch. We've discussed my affair with New York, my love affair with New York. I had left you with John Armitage, and there was a conversation in New York over
John
lunch.
Armitage is a genius,
yeah. And so actually the manager that I was having lunch with, William von Muffling then left several years later and launched his own hedge fund. He left Lazard Freer, traded under his von Muff kind of thing. And headhunters approached me looking for someone, not me, but looking for someone. Maybe they were looking for me, and I was like, no, I was very content with my life with Chrisman.
What, to go work for Muffling? To go work for Muffling?
No, to take over the vacancy left by him.
Oh, to take his place. All right. So you could have been William von Muffling the 25th, technically, sort of.
I would have put the muff into von Muffling. Anyway, I recommended the guy, and forgive me, no surprise, but I can't even remember his name. But he'd worked with Chrisman, he'd worked with Soros, and I say supercilious, which is to say, SOB. I mean, he was just so full of himself. It's amazing he could stand up straight with all the kind of, the love he was carrying for himself. But
he couldn't get through doors, his head was too big.
And he said to me, he blotted out, John Armitage is an effing genius. Okay, why? Because Armitage, and again, you had said something, is John Armitage a hedge fund legend? And I said, let's come back to it. So let's revisit it. John Armitage is an effing genius because he had wisdom, and he came to recognize and doubt the role of shorts or shorting in a hedge fund. He said, I don't need it. What does it serve? I'm really good at picking things that go higher. I've been taught that if I mix it with speculations on things that go lower, then intuitively or logically more than anything else, that should reduce the overall risk. And one of the things, not to overcomplicate, is a Sharpe ratio. If you can kind of actually make money, but with less incidence of volatility, and so it's a smoother making money, like Chase, Coleman, and Rokos in the last while have had a bit of like that. So which is to say their Sharpe ratio has come down. If you've got a very low Sharpe ratio, it means clients can give you more money. We're all in it for money. Anyway, he said, actually, when I look at it, it's just a damn loss center. I just lose money. And if I want to control risk, I should do so with maybe judiciously taking profits on things which have worked. Certainly cutting things which haven't worked and kind of feel like I've made an error, and that's going to happen. And then cutting the exposure, the amount, because there'll be time. We talked about leverage. And all of these managers, there are times when the ball feels like bigger than a basketball, and they can't miss swinging and hitting it. And so you want to swing with a loads more of money. And there are times when it's as tiny as a table tennis ball and swinging
ping pong. Yeah.
And you're going to come down in terms of your size. So I'm not going to short. And that's damn genius. And that's why today, back then he was a legend. And today he's very much a legend because he came to that understanding. And I got to tell you, not only he, and it's a rare thing, and therefore it's notable, but William Vaughan Muffling did the same. After a while, I said, you know what? And both to their credit, they lowered either their performance or their management fee or both. And which meant either don't pay. I'm not going to charge you 20. I'm going to charge you 15 in terms of any profits I make for you, because notionally I'm not doing everything you might expect. So John Armitage and William Vaughan Muffling, shorts, AMC, GameStop. We're covering it all, Chris. And there's another link we can go on. So Chris, over to you.
Yeah, I think what's quite interesting about that is, Hugh, we're talking about short selling there, and I think for the general public, and I speak on behalf of them, is that short selling is sexy. You know, we've all seen the movie The Big Short. People like that idea of guys like yourself getting in there, making a lot of money. There's somebody, you know, going bankrupt. There's disasters. People have seen things ahead of time. There's that element of mystery, sexiness, and glamour that short selling will always grab the attention of the people. But we'd like to bring up A.W. Jones. Now, he is the first hedge fund manager, for everyone else out there that's maybe unaware of him. An Australian lad, moved over to America and formed this. But he was the first person, obviously, then to bring these two things together. Because, like you're saying, bring the balance to the short sale, looking forward, and bringing that synergy together.
It was being catapulted into fame, or the spotlight of fame, because of the Forbes article, which brought to the masses. You called them the plebs. I will refrain.
The unwashed. The unwashed.
Yeah. It introduced. It was the first cultural introduction of the term hedge fund manager, and I this time of when I was writing at the end of 2005. Let's see. I gave mention to it. There you go. Did I say Forbes? It was Fortune article.
Written, yeah, Fortune article. Yeah.
So I say it was written in 69. Maybe it did start in 66. What can I say about that? I can say several things. So Paradox. I love Paradox. So here's the guy who culturally brought this stain of hedge funds into the popular perception, and yet today people are like, who? A.W. Jones? Who? I actually think there's still I still think there is an investment management business bearing his name to this day, but as a character, as a player, he never made it out of the 60s. And again, this goes back. Crikey, I've got mosquitoes. This goes back to this notion of, I was never trying to, my strategy, I was never trying to outsmart. I love these things. What I want to say is from 66 to 69, the market had peaked. There were some amazing bull markets, but there was a heck of a lot of volatility. It was a killing field for investors. Markets were gyrating wildly. And he was finding that judiciously, he was trying to determine how much to be long, to be in his stocks. And so he was judiciously changing that up and down. And at the same time, he was having to make the same decision with shorts, how much to be short versus his assets. And there was a multiplication of the number of decisions he had to make. And so he was finding complexity was getting in his way, and he felt it was subtracting from his returns. And he felt actually he needed to earn more to be sexier than everyone else. And so he persuaded himself and his clients to stop shorting. And he went very long the things which were in these bubbles, the things that he stopped shorting and he bought the winners. And in 69, the market caught up with him, and maybe we're seeing in NASDAQ, maybe we're seeing in the 10-year Treasury market, but a longish trend reversed, and it reversed dramatically. Certainly what we're seeing with Cathy Woods.
Cathy Woods, and her ARC, yeah.
And so the irony was the fund that came first to the public's mind to be the epitome of controlling risk through the the position of shorts pitched against longs, once it went through the reality of trying to trade a market which was going up and down, and feeling this compulsion to print better numbers, it forewent all of its laudable kind of founding ethos, took it all away, and then the market went, "Got you, you idiot!" And boom, he was destroyed. He lost, I don't know, 40% in a year. Clients just went, "You're a muppet.
You're gone." Yeah,
you're gone. And that's why we are bringing up this. We're bringing up a phantom. The father of modern hedge fund management is a phantom because he couldn't. And again, it's my favorite. I haven't told my most boring story of all time for a while, so let's do it again. It is Peter or Paul in the Garden of Gethsemane or whatever it's called, and Jesus is there, and the guards come, and they're like, "The guy with the beard, is that Jesus? Is that God?" And like, "That guy? Dude, I've never met him. I have no idea who that guy is." And that's what A.W. Jones was saying in 1996. Shorts. Never heard of them. Probity, intensive research, diversify portfolios. We just buy things that are going up. Anyway, there you go.
Well, see, I think also the parable here is, what's the parable? When the tide goes out, you find out who's swimming naked. And markets are a way of doing that now. They put the tide out and you see who's swimming naked. Is that fair to say? Am I? That's how I kind of see that as a summation of what you've been saying.
Yeah, I mean, that comes, I don't know the original author of that. It comes to most people's attention via Warren Buffett quoting that.
Yeah.
And I have to tell you, I wear proper chic shorts.
Not that he needs to. He's well endowed. It's not an embarrassment. It's just,
how do you know? I mean, what do you see with this? Do I not switch this camera off?
I'm in there all night, Hugh. I'm in this.
You got the man love.
Exactly.
I've got my bat ready for you. But actually, linking it to what we were saying, if I don't edit it out, the run on Celine Beach. I mean, God Almighty! For some reason, I mean, it's the nudie beach. It's the risque one where it's quieter, and I go running at 7 or 8 o'clock in the morning. And at that time in the morning, there are these middle-aged guys, and so I run the beaches, back down and back up is a kilometer. So it's a nice metric kind of gauge. Damn, it's a nice gauge. But I've got to kind of zigzag between all the naked folk. And try walking on a beach naked with your big bang ding dong. I thought, well, maybe I'll try it. It's preposterous. No one wants to see your landing gear, and it's not comfortable. It just fails at every level. But anyway, next.
I've never done it myself, but yeah, fair play. Moving on. But in this monthly, so November 2005, you've got everything on. You feel as though things are not going away, so you start to unload, get rid of things, get yourself a bit more flexibility, and that links to Ken Fisher. You were saying earlier on, we were talking about Ken Fisher, and that was you were enamored with one of his techniques that you had learned, and you sort of related it back, and then you thought about the time when you wrote a letter to, well, not to him, you wrote to his son, didn't you? You sent a letter to his son, who maybe was not as forthcoming as he could have been.
Oh, he was forthcoming, all right.
Well, the other way. The other way.
Oh, that wasn't a problem. Yes. So actually, let's link it to A.W. Jones. So Alfred was the godfather of modern hedge funds. Ken Fisher's father, Phil Fisher, via a book that he published in the 1950s, created a term which hasn't actually traveled well in terms of the name and the retention of the name, but it still has resonance in the US. It's called scuttlebutting. Say
Scuttlebutting,
scuttlebutting.
yes.
Say that to someone in the UK, and I'm like, oh.
I thought that was an English. I thought that was like an old English term. I didn't realize that was an American term. Scuttlebucking.
Well, its origin, I'm sure, is Old English. But I mean, what would you
scuttlebutting? I don't know. I would think nonsense, like you were doing nonsense, like you were like doing something like you were wasting your time and you were up to all sorts of nonsense. Basically, if someone said that to me.
Well, some might say it's all bloody nonsense. So scuttlebutting and what he was a very successful purveyor. He was a professional investor with his own investment advisory business, and the scuttlebutting was active stock investment research. Active in the sense that it wasn't just Benjamin Graham, and when I say just, is not to put down the immense intellect of Benjamin Graham, but it was not just being hidebound to your desk and going through annual reports. It was actually getting off your bum and getting out into the field and actually going round and visiting factories or shops and meeting the management, going on tours or in its later day, hedge funds would employ surveillance, detectives, kids to be measuring. They would have drones. I mean, I've seen this, like drones observing activity in Chinese ports or Chinese factories or the supermarkets, like the car park. How busy is it? And what's the average? And if you see the car park for some whizzy out of town retailer, and normally the car park is 80% full, but in the last quarter it was 65%. There's a profit warning coming. That's scuttlebutting. And
kicking the tires. Yeah.
Kicking the tires. Yeah, kicking the tires. And the proponent, the first proponent of that was Phil. Now, Ken, his son, took over the reins of the business. And Ken Fisher wrote his own book. And he took the family business to preposterously high scale.
Super Stocks, that's what you're talking about. That's the book, right? Super Stocks, yeah? That's the book you're talking about.
The book is Super Stocks. And people always ask me for recommendations, and I always neglect it. Maybe I neglect it because Ken is an ass. We'll come to that. Super Stocks.
Oh, he's in today, people. The knife's out. Yes, come on. Okay, carry on. Sorry.
However, Super Stocks is a great book. Haven't looked at it. I mean, remember, my wife did burn my library in protest at my absence in St Barts, and so I've not had the opportunity to lift, to touch, to finger some of the books from the past. However, Super Stocks and its impact on me was its concentration on price to sales, or enterprise value to sales, as the key metric of valuation in trying to kind of guess and determine whether businesses are over or underrated by your peer group, if they're too rich and therefore subject to the fear of entering a bear market and losing money. And if I was to give you a really, really hackneyed version of that, let's say Unilever is predictable, albeit it's been a little bit less predictable. We were talking about Ben and Jerry's. We were talking about them being a bit wokish. And then in the last week, they've kind of gone, whoa! And they said, let's spend 50 billion sterling, I think the figure is, and buy the consumer healthcare portfolio jointly owned by Pfizer and Glaxo. And investors are like, really? Not a good idea. Anyway, but Unilever, and so actually the investors are going, we own you because you're a bit wokish, but you're boring, you're predictable. And now you're talking about jazzing yourself up and stay in the box. It's kind of the dialogue that's happening. Anyway, for a business like that, where it grows every year and it grows in line with the economy, plus or minus, or plus the inflation rate, which is to say probably grows somewhere like 7-8% long-term earnings. It has profit margins which over time seem to gravitate around 10%. There's a very rational argument that you would pay an enterprise value of 1 times sales, the annual sales of Unilever. And that 1 times in today's environment where bond yields, again, everything comes back to bond yields, where bond yields are trading well below their historical levels. So again, last week we noted that in the summer of 1982, the 10-year bond yield was 16%, and only 18 months ago it hit 0.4. So clearly we are in a different era. So the 1 times enterprise value to sales might be more like 1.5, 1.75 to sales on account of where bonds trade. And so again, if the bond market is to leave its bull market, and if bond yields are to now slowly or rapidly tick up over the course of the next 40 years, that will have negative implications for all businesses in terms of how they're rated on the stock market. Anyway, I thought it was simple. I thought his reasoning, I thought the justifications, and actually it kind of course, it married with probably what I was doing at Baillie Gifford and where in Edinburgh, the kind of deep fundamental analysis that I had gravitated to. And so it was the things that resonate with you are the ones that legitimize your behavior. My new man crush on Angus Fletcher, the professor of creativity that we had the show before Christmas with, he was the first person to come to me and actually be able to legitimize what I thought was my crazy, stupid, infantile behavior for the last 25 years. Like, no, that means you're creative. So, thanks, Angus.
Yeah, and if you want to go on the beach nude in St Barts, Hugh's happy to look at you. You said you got a man crush on him. Say man crush. The offer's there, Angus. The offer's there.
All these swinging dicks on the beach with Celine just get in the way. Thankfully, I'm kind of mega focused. Actually, one of the things with that, Chris, how do you run? I am now running.
How do I run? What do you mean? How do I run?
Well, how do you run with your nose?
How do I run with my nose? I don't even know what you mean. What do you mean by that?
So I now, and thankfully, I've overcome some of the unpleasantness. I run breathing through my nose, which is I keep my mouth closed, and the oxygen has got to come via the filter of my nose.
No, I definitely don't do that. No, I've never even thought about doing that. No.
You should. Try it. It's very unpleasant.
I can imagine it is. Yeah, I can imagine it is, especially when you get your heart rate up and stuff. It must be pretty difficult.
It's hard to draw you feel like you're drowning. You know, when you're under the water and you're trying to catch it. Yeah. Your body's saying, you hit me with the oxygen. I've got fatigue down here, the hydrochromia, whatever it's called, the little cells which create the energy. They're like, we're the power station here. We need oxygen. Come on, whip me. And that's a bit like how I felt. I guys probably look like a coke fiend. That's a bit like how I felt in January, February of 1999, or maybe it was October 1998.
Is this when you pen a letter to Ken Fisher? And do you actually, is this pre-email? Because no,
we had email.
Right, okay. So did you email him or did you actually get pen to paper?
Not that damn old.
No, I'm saying I'm not saying you're old, but I'm just saying I can't really remember. I wasn't. I was in 2000. I was still.
You can tell me you weren't born.
No, I was born, but I was still. I was at school. I was still at school. So yeah. So anyway.
No, I don't want to hear.
But I can't remember. We had computers, but email wasn't as no one was using email like they are today. Even I know we had computers and all that stuff, but email wasn't quite as prevalent, was it?
So I was at Credit Suisse, and I was responsible for UK equities, and the biggest company at the time in Europe was Vodafone, and it had just acquired Mannesmann, its German competitor. And again, it had a higher rating than the German, and so just that kind of stupid kind of plunking the two together. It'd been making acquisitions with that stupid game. And the share price shouldn't rise. It should rise if there are synergies, if there are kind of cost savings, or there is the ability to accelerate the growth of the business by the combination of the two entities, then the share price should rise. But not owing to, silly smoke and mirrors. I buy you, my stock's on 25 times, I'm buying you for 15 times earnings, and then your earnings are going to be re-rated to 25. That it lasts for periods. That's what suckered old Alfred. But it doesn't endure because it's nonsense. Anyway, when I looked at the enterprise value to sales of Vodafone, I don't know it must have been maybe 8, 9, 10, maybe 12 times. And I considered where the profit margin when the business matured would go to. It would go to a high level. It would probably be in the 40s. And when I consider the growth rate, at some point when you've rolled out back then 2G, 3G, 4G, and now we're on the cusp of 5G, there would be an S curve which would then become linear and flat linear. And therefore you'd be approached. And so for a business earning 40% margins, you would be kind of 4, 5, 5.5 times would be the multiple. And so you sit there in 1999, you kind of make some reasonably aggressive estimates for where sales are going to go to. Then you apply that terminal valuation. And you couldn't get close to matching the valuation of Vodafone. So, I guess I thought, smart me, two things at the same time. I thought, this has been inspired by Ken's work, been inspired by his book. And I'd like to reach out. I'd like to share it with him. And maybe I'm in the most unlikely event, he'll come back. And he sure enough came by. He was vile. He's like, do your own homework. Don't bother me. It was just mean. It was like, whoa. So yeah, Ken, if you're listening, you're an ass.
Well, Ken also got us in a bit of trouble, and I'll mention to people. So Ken involved a little bit of controversy. So and I'm reading this from CNBC. So we're not creating these quotes. These are online. People can check them out. At a conference in 2018, Ken was talking about our marketing mutual funds, and he said, the most stupid thing you can do, which is what every mutual fund firm in the world always did, was to brag about performance in a direct mail piece, which is a little bit like walking into a bar if you're a single guy and you want to get laid and walking up to some girl and saying, hey, you want to have sex? But not only did he didn't put the spade away, he dug on, and he's also been quoted as, another one of his black marks in a similar vein. He continued on saying, I don't know if I could, but if I was 30 years old and I had to do it over again, I'd have more sex I could. Once you get older, you're like a Christmas tree. You're firm once a year, and the balls are just for decoration.
So we have to wind up, but we can't wind up without having some blinking kind of modern commentary on markets. And I'm going to try and be bold and daring, and I'm going to really be ridiculous. But I think it's time to buy more gold shares again. I hesitate to say that because it's going up. As soon as you buy, it's going down. And gold shares, they're not things that go down a little bit. They'll go from $16 to $4. I mean, and I can talk about emotional or paradoxical investing. You're talking about this concept of trying to hang on to something, and it's a bronching belly and it's trying to kick you off. That's gold. I want to say that, and no one will have seen this, but on Twitter, the end of July 2020, or maybe it was August, I did put things out saying, personally, I think gold's the movement's a bit too advanced, a bit too rich. So that was August 2020. That's quite a while ago. And that was right. So round about then, gold peaked $2,075 an ounce or thereabouts. And within about 10 months, it was trading as low as 1650 or so, that's chunky. That's a good, I was telling you, it had entered a bear market, 20% correction. And so then you, like the silly people say, it's a bear market, so I've got to sell everything, or I've got to short sell. And as soon as you do that, gold went from 1650 or so, and it went to 1950, which is it jumped, 15%. Yeah, and so it's been a bit like poor old A.W. Jones from 66 to 69. That the market has been up and down, spreading confusion at a time when our Bitcoin friends had only been going higher. And so without a doubt, some of the psychopathic love affair that dare not name itself for gold had been taken away and stolen by the Bitcoin community. And so there were less flows of funds coming in. But gold, as I look at it, I'm sharing the chart with you today, and you can see that I've got these downtrend lines, so what is fanning out, and these are patterns, shapes, forms which don't predict the future, but give you an inkling with regard to the insanity of the conversations that go on inside professional money managers' head. Really been almost impossible to own this. You've lost money in the last best part of 2 years when everything else has gone up, and that is very hard for people to stomach. And I noticed it was just last night I noticed, and that's what gold does. It's like so the only stocks that I own, I have a pension fund, which I will in the UK you can redeem it when you're 55. I just got to reach 55, and I'll redeem it. But it's presently just invested in a collection of gold and silver shares. If gold rallies hard enough, I will swap some of those names into uranium, and hopefully, actually, gold and silver might have this movement, and we might see a further retracement in uranium. That would be gold. That would be really exciting. But like yesterday, and to show you how hard this area is to navigate. So, having done nothing, and worse than nothing, having been like profoundly volatile. Like the stocks I owned were up 16%. I'm like, 16% in a day, that's like that can be 2 years performance for some business. I'm like, hello, what happened? I'm not sure what happened. Nothing has to happen. The bear market had served its time. It's still presumptive of me to say that that bear market is over, but it's looking more and more likely that the 10-year Treasury, and I'm speculating here, but it's looking more and more likely that it will breach 2%. It is looking more and more likely that the Federal Reserve will raise interest rates at a faster clip than was anticipated 3 months ago. I think it's more than likely that policy mistakes will be made, and gold is one of these things that doesn't have a value. You buy it because it's going up, and gold, you're making me old. Actually, you might make me a little bit richer. So we'll see. So I'm just flagging that on my personal dashboard, something happened yesterday, and maybe it was just a day of insanity. I know what happened. A manager, and I'm not saying I know the manager, but someone with quite a bit of money has clearly made an asset allocation to raise their gold exposure.
Do you have a suspicion who that is? Maybe you can't say, but do you have no?
Not a suspicion, not a desire. I don't care. I don't care. I only care that more and more strangers are persuaded to do the same and change the trend. But I think someone with a bit of money came in, and it's like dropping a pebble into the ripples.
Yeah.
The ripples. There's just not enough liquidity. There's not enough buying and selling going on in that market. It's been dead. It's just been nutters like me who've had shares, and I haven't touched it for 2 years. So there you go, Chris. I'm done. I hope The damn microphone keeps people.
Well, hold on. Before we go, you've just had your insight into the Hugh Henry family office. But before we go, we've got the Asset Capitalist Wheel of Fortune. Remember, he picks a number between 1 and 59. There's random words assigned, and he has to give us a hedge fund story. You cannot pick 19 and 14. Those have been your two choices. So between 1 and 59, Hugh, spin the wheel, please.
44.
44. Right. Number 44 is gloves. Do you have a hedge fund story involving gloves?
Wow. Well, that's so random.
Yeah, but they're all that's the point. They're all random words. Yeah, I made them all pretty random. That's the whole. You've got stories about everything in hedge funds.
I thought they were all a bit loaded because you know the backstory, and they're like, I've got a chance to get out of Dodge. Trading under our own regulatory license in September of that year. And it really just wouldn't have happened without the amazing efforts of the guy who came with me, who had been the chief executive or operating whatever, the plumber. You know, hedge funds are complicated, and there are so many relationships, parallel and otherwise, and money moving left, right, and center. Money doesn't sleep; it's 24/7, and technology's changing. You've got to be upgrading systems, and you've got to be watching like a hawk for any errors. We're human; we make errors, and he was the best. I said he was the best in the city because we got that regulatory license in record-breaking time, 6 months. I mean, no one gets it in 6 months. And when you consider at the time, I was like fantasizing about Narnia and cupboards and going in and coming out dressed as a cowboy or whatever. You know, I was not the kind of general material for a quick turnaround on a regulatory license. But the boss, the straight guy who made this all happen, boy, he liked Ferraris. He had the most spectacular Ferrari in a kind of powdered metallic blue. And it was one of those ones. In fact, my next door neighbor had exactly the same. What was it of my life? My next door
can we see a thing? Was that the Rockstar?
No,
that was the Rockstar. Okay.
No, and actually, that's a good link because he was a chartered accountant. So all the straight guys had the sexy cars. All the nut jobs, I was like, it's beautiful. Would I buy it?
Okay, so the Rockstar was one side and this guy was the other side. Is that right?
Kinda, yeah.
Yeah. Okay.
The Rockstar was maybe like 3 or 4 in between.
All right. Okay.
And he drove it wearing gloves, driver's gloves. And I just always thought that was just so preposterous.
What would he do with the gloves? Would he wouldn't keep them on, would he, when he wasn't driving?
He was the type guy, it was his makeup. And he had to kind of just take people down. And so I imagine that the gloves periodically probably came out of a leather case, and he would, you idiot, now get back to your office. And men would be reduced to men tears. That again I'm not saying that happened, but I'm saying that's the kind of thing I conjure up when you bring to my attention gloves. I hate guys should never wear gloves. And I say that, I had a mountaineering history, and I did wear gloves. And the most painful, awful thing to be avoided is, so I would be winter climbing, and I'd be below, someone would be above, and I'd be, feeding the rope, and I'd be attached to screws to rock or ice. We asked you, I think you mentioned, but there's a kind of sexy public love affair. We hate it, we love it, but we watch it, the short selling.
Yeah, definitely.
Because someone could die financially. And it's a bit like that. I have the favorite movie I've seen this year is a small window. The Alpinist, the Alpine Climber, the Alpinist. Wow. I mean, I'm sure a lot of people will have seen the one with the solo mountain climber. Was it called Solo, or the guy climbing Yosemite? And the shots you see, and he's got nothing attaching him to the cliff face, and one mistake, and he's dead. The sanction is death. I climbed in Yosemite, and I was leading. So, which is, I wasn't belaying, I wasn't below, I was above making the route. But I had ropes and I was attaching, and I was like, whoa, attaching all these carabinas and whatever into rock fissures. And there was something interrupted the universe. It wasn't a noise, but I became aware of the presence of another person. And there was a solo climber beside me with radiating happiness.
Nothing.
And just like, whoa, with nothing. And just the cosmic rays, they nearly pushed me off the mountain. I was like, oh no. This is good, like a ghost. These guys are ghost-like. I have admiration, fear, but they're attaining things which is beyond the realm of reason. I only mention that because the beeling and having to stand or being attached to this rock, and with wind and snow falling on you and ice falling on you, there were times even with the gloves you lose touch of the tips of your fingers. It's so unpleasant, and it's even worse that because the blood circulation ebbs and flows and it comes away from the periphery, leaving without blood you lose the heat. When the blood comes back, it's even worse. It's so painful. So there were times when I wore gloves, they didn't do me any good. And actually, the alpinist, you see this guy doing all that solo climbing, but in winter, and climbing things with crampons and ice and rock.
No gloves.
And it's in Argentina, no gloves. I'd recommend it. Watch it. It's amazing. It puts our life into perspective.
Well, talking about lives, we had Jeffrey Bezos talking about living forever. Hugh's on his not eating 20 hours a day, only eating a handful of Brazil nuts and a chopped avocado in the bid to live longer. So I think it's nice we end with a little quotation or parable from Mr. Noel Gallagher. I don't want to die. Maybe I just want to breathe. Maybe I just don't believe. Maybe you're the same as me. We see things they'll never see. You and I are going to live forever.
You betcha, baby.
Goodbye, everybody.
Goodbye. And of course, the next time you hear about me, you probably hear I've been run over and killed by an errant surfboard on the waves of St Barts.
Whilst wearing gloves.
No, not wearing gloves, I can assure you. Actually, I do wear gloves sailing, but there you go. Thank you. Bye-bye.